Hello, everyone, and thank you for joining us. The Wall Street Blockchain Alliance is very proud to offer our latest webinar, IRS Updates for Digital Assets, Key Regulatory Changes for 2025. Before we begin, a bit of housekeeping for today's session. Please keep in mind that this event is offered for general information and educational purposes only, and it is not intended to constitute investment, legal, tax, or accounting advice. Any views or opinions expressed during this event are those of the participants, don't necessarily reflect the views of the Wall Street Blockchain Alliance or our participants' firms. This webinar is being recorded. All webinar attendees will be in listen-only mode. Attendees, you are certainly encouraged to submit questions for our presenters, using the Zoom Q&A function, and we will, of course, reserve time at the end of the event for audience Q&A. And with that, I will turn it over to our thought leaders, Jessalyn Dean of Ledgible and Nick Fahrer of Forvis Mazars. Jessalyn, Nick, over to you.
Awesome. Thanks for that warm introduction there, Ron. We're about to dive really deep into tax season here in the US. And so we're super excited for to come here today and talk to you guys about some IRS updates for digital assets and talk about what filing season is going to look like for the 2024 tax year and also going forward so that you guys have all this information at your fingertips. And I know when we talk about digital assets and crypto and accounting, everyone gets super excited. So I expect everyone to be super plugged in. A little bit of a joke there. I know that some eyes can gloss over when we get into such a niche topic, but please, if you have questions, use the Q&A uh, feature within Zoom. Submit your questions. I love being challenged. I may not know the answer to everything. Jessalyn may not know the answer to everything, so we may have to circle back and answer those questions in a bit. But love questions, and we'll be diving in here to quite a few different things. So uh, let's go to the next slide here, Ron. Yep, and Jessalyn, maybe I'll introduce myself and then you can introduce yourself as well. So I guess before we dive in, I probably should have done this here a little bit earlier as well. I'm a director at Forvis Mazars. We are the eighth largest accounting firm in the world now with offices in over 100 different countries. And I'm the blockchain and digital asset practice leader. I'm a CPA. I've been in crypto since 2017, been serving clients in this area since 2017. I had a friend tell me about Bitcoin in 2014, and I laughed in his face and then told him he was crazy. I wish I would have listened to him sooner, but here we are. So, Jessalyn, maybe over to you.
Thanks, Nick. I'm Jessalyn Dean, the VP of Tax Information Reporting at Ledgible. I started my career in the TradFi space, but always within tax reporting in the last 10, 12 years. So all things 1099 cost basis, 1042S. I got my entry into the digital asset space when I was heading the implementation of 1099 reporting at one of the top 10 crypto exchanges. And now I'm our in-house subject matter expert here at Ledgible, where we provide tax data and accounting software solutions in this industry. So I think we can move to the next slide. We've got our agenda up here. These are kind of the four broad topics that we're going to get into. Nick and I are really going to try and make sure that we're transitioning how we talk between issues facing brokers that need to hand out 1099s and issues facing taxpayers that are going to receive 1099s. And we'll see in one of our slides that not being able to distinguish these two has caused a lot of confusion for people in the last weeks and months. So we can move to the next slide. We'll start with this bullet and I'll hand it back to Nick.
Yep, we'll start with the current state of IRS regulations on digital assets. So, if you'll navigate to the next slide here. So there's a lot going on in this slide, I'll admit it. I'm going to start in the top left corner of this table. So where you see what happened in July 2024, that's where I'm going to start. And I'm going to work left to right first, and then I'll move from top to bottom. So what happened in July 2024, now moving over one box to centralized brokers. The IRS released final guidance. Essentially, I'm oversimplifying, but essentially saying that centralized brokers, so think your Coinbases, your Krakens, your Geminis, those types of centralized exchanges in the US will need to report gross proceeds on what's called a 1099 DA, starting with transactions on or after January 1st of 2025. So we've already passed that time frame, so these brokers should already be preparing for this. And those 1099 DAs will be reported and issued in the beginning first 2 months of 2026. So we still have a bit until those are actually issued, but those centralized brokers should be preparing for that currently. And as a taxpayer, you should be expecting to receive 1099 DAs on these transactions that you perform within those centralized brokers that began on 1/1 of 2025. So something to keep in mind if you own crypto yourself. Uh, those final regs also said that cost basis reporting for these centralized brokers is not required until transactions that occur on or after January 1st of 2026. Now those are acquisitions on January 1st, 2026 or after. So a theoretical situation, if I purchased Bitcoin in 2022 and I held it and didn't sell it until January of 2026, that centralized broker is still not required to report cost basis on those 1099 DAs, only gross proceeds. So it'll only be those transactions that are acquired on or after January 1st, 2026, where cost basis is reported. So continuing down in that same box still so far. So that was addressed by the final 6045 regs, and there was a couple notices that the IRS issued. Now going over to the right for DeFi brokers, and we'll dive into this a little bit deeper later and really define what a DeFi broker means. The IRS basically said, we are going to defer what DeFi brokers have to report on 1099 DAs, but we reserve the right to issue final regs again later. And they even said that they were going to do it by the end of the calendar year in 2024. They did live up to that promise. We'll dive into that here a little bit later. So now moving even further to the right on the taxpayers column. So what does this mean for taxpayers? These final regs that the IRS release. Well, first of all, there was a rev proc that was issued as a part of these final regs. The final regs said, listen, we understand that taxpayers have been using this, what's called a universal approach to determining how they're coming up with their cost basis for their sales. We disagree with that approach. We think it should be on a wallet by wallet basis. And so because of that, they've released this rev proc that says, we understand that you've been doing this in the past. We're gonna play nice. We're gonna give you a one-time opportunity to actually transition from universal to wallet by wallet. And if you live up to this, what's called safe harbor, then we basically won't ask any questions of what happened in 2024 or prior. And that was that Rev Proc 2024-28 that you see here on the screen. So now moving down a row, what happened in December 2024 under the centralized brokers columns, nothing changed, right? So the final regs that was issued in July 2024 primarily addressed centralized brokers. However, on December 27th, I remember this day like it was yesterday because I spent 6 hours reading over 100 pages of final regs on this. The IRS lived up to their promise. They released final regs for DeFi brokers. And I don't want to steal Jessalyn's thunder on this because she's going to dive into this a little bit deeper. But essentially, they said that DeFi brokers are also going to have to report transactions on a 1099 DA, starting with transactions that occur on January 1st, 2027 and going forward. So Jessalyn will dive into this a little bit more, give us some more flavor on this a little bit later. For taxpayers, basically what this means is, and before I dive in, there was also a notice that was released around the same time, Notice 2025-07. The IRS in this notice says for custodial brokers, right? So going back up to that top row, we understand that some custodial brokers, like I said, Coinbase, Gemini, Kraken, some of these brokers and centralized exchanges in the US may not currently give their retail customers the option to choose if they want to use FIFO, HIFO, or LIFO. And that's considered a specific ID allocation if you choose HIFO or LIFO. And because they haven't given their customers that option to select that yet, IRS again is playing pretty nice if you ask me. And they said, listen, we understand that these brokers haven't set this up yet, so we're going to give taxpayers the option to determine what that is in their books and records, even though some of these custodial brokers don't currently have it set up yet. And that's important because otherwise, taxpayers would have had to default into FIFO. So if you wanted to use HIFO or LIFO, you wouldn't have been able to without this notice. So just some key takeaways. I'm on the bottom row now. Under centralized brokers, they do not have any new relief to continue and build out their 1099 DA systems. There was a bit of confusion with that notice 2025-07 that it basically meant that custodial brokers didn't have to report 1099 DAs anymore. That is not the case at all. That notice is specifically focused on taxpayers, not custodial brokers. DeFi brokers, one key takeaway is, they were already deferred. We weren't sure when we were going to get that final guidance, but we got it on December 27th. And DeFi brokers need to start preparing for this going into effect in 2027. We'll dive into if maybe this could get delayed again even more or even repealed a little bit later, but that's a key takeaway there. And then for taxpayers, there's no relief or delay for taxpayers to move from universal to wallet by wallet. Even if you didn't meet the safe harbor in that rev proc that the IRS gave us, you still need to transition. And if you don't transition, then you're exposing yourself to risk as a taxpayer by reporting in that way. So, all right, we'll go to the next slide here. And Jessalyn, I may stop. Anything that you wanted to add in there that I may have missed, or I can keep rocking and rolling here.
No, keep rocking and rolling.
All right. So just to recap again, the state of regulations currently, DeFi broker regs published on December 27th, and the very next day, there was the first lawsuit that was filed by the DeFi Education Fund. I kind of alluded to this in the last slide. So you can kind of, based on the fact that this lawsuit was filed on the very next day, they probably had some sort of insider knowledge and were anticipating this. And then in January of 2025, there was a joint resolution that was introduced in the Senate to repeal and cancel the DeFi broker regs. It's currently with the Senate Finance Committee, has over 10 co-sponsors led by Senator Ted Cruz. TBD on if this will actually move through and be passed, but given the fact that there are 10 co-sponsors, could be seen as a sign that there's a strong possibility of that. So what that means is DeFi broker regs, the ones that came out on December 27th, could be repealed before they actually go into effect. But don't expect centralized broker reporting to be repealed or taken back at all. I think most can agree that it is a good thing that these centralized brokers will be reporting these transactions on a 1099 DA going forward. I mean, frankly, if you're signing up for one of those accounts, you're getting KYC, AML, all those sorts of things anyways, and this should ideally help those customers report their information on their taxes. So we can go to the next slide. So what to expect for 2024 tax returns filed in 2025? It will be mostly consistent with what we've seen in prior years. There are some tweaks, but starting again on the left side in the top left, these are kind of what forms, if you're a taxpayer, you can expect to receive. So you may receive a 1099 miss or a 1099 NEC from a custodial broker, for example. If you had, again, another example, staking income or some sort of rewards, and typically the threshold to receiving these is $600 or more. So to the extent you received more than $600 in staking income, you could expect to receive one of these 1099s. Taxpayers will then need to report that on a new Schedule 1, Line 8V. This is new in 2024. They specifically called out what's called, I think, I have to go back and look at it, but I think it's digital asset rewards not reported on another line or something to that extent. So they know, the IRS knows that there are people out there earning these types of rewards. And then you may also expect to receive a 1099-B. I moved down a row here. So taxpayers that may be traded within platforms such as Robinhood, PayPal, or eToro are issuing 1099-Bs. Now, they're not required to issue those. So, you may participate in some of these other centralized exchanges and you may not get one of those 1099-Bs, but those are some examples of where you could see a 1099-B. And that's going to be your typical trading schedule, which gets reported on Schedule D and a Form 8949 on a personal tax return or even a corporate and partnership tax return as well. So then there are other reports, right? Because currently 1099 DAs are not required. And these are reports that if you're a taxpayer and you had activity in this space, that you will have to go and seek these out on your own. And that would be a CSV file of your trading history, which should report all of your trading history. You can manually take that information and try to calculate your cost basis and proceeds. I don't necessarily recommend that if you have several transactions. There are several reputable crypto accounting and subledger out there that can help you file these and help automate some of that process. Again, this gets reported on Schedule D and 8949. What I want to highlight though is that just because you don't get a 1099 doesn't mean that you don't necessarily need to report it. If you had trading activity, you still need to report it even if you didn't get a 1099. And that's one of the reasons why the IRS is issuing these final regs on 1099 DAs, is because they realize there's a lot of underreporting, because there's a misconception that if you don't receive a 1099, you don't have to report it on your taxes. So go seek this out, even if you didn't get a 1099. And then finally, we'll dive into this in a little bit more detail here later, but there's these things called ETF tax letters. So Bitcoin and Ethereum ETFs were launched for the very first time in January of 2024, and that we saw a ton of activity in those ETFs. So people that invested in those will need to go out and seek these tax letters. These tax letters help taxpayers calculate additional expenses that the trust incurred. These ETFs are structured as grantor trust, and they pay expenses in the Bitcoin or Ethereum that they're holding within the trust. So there's expenses that you may need to account for, and there could also be additional gain or loss that the trust sold that Bitcoin or Ethereum to pay for those expenses that is not captured on a Form 1099-B that you'll need to go through and calculate. So we'll dive into that a little bit more, but we can go to the next slide here. And Jessalyn, I believe this is, I'll hand it over to you here.
Great. And before I go through this slide, there was a question in the Q&A that I can answer. Do you expect the new Congress to change the reporting requirements for centralized exchanges, like implement more de minimis thresholds or something? And my answer is we do not expect any changes like this, largely because we're not hearing from industry participants, brokers, that they need or want this. Why aren't we hearing that? Well, we'll see this in a future slide, so a little spoiler alert. Even where a crypto exchange or centralized exchange or a broker does not report a transaction on a 1099 because it's aggregated or hits a de minimis threshold, the taxpayer still has to pick it up. So there are many brokers out there that are considering not even using de minimis thresholds as a customer service to their customers. It's challenging to actually implement the de minimis thresholds, and their customers need the information anyway. So you're just not hearing a lot of noise from brokers asking for more de minimis thresholds or related exemptions. So moving on to the content of this slide, this is a really simplified timeline of rules we have right now. It's just another way to frame up some of the content that Nick walked through on the previous slide. This does not include any rules for which we have not received any guidance yet. We have a slide near the end about what's missing and pending, like transfers of cost basis, the International Crypto Asset Reporting Framework, the CARF data exchange. So right now in 2025, what are we looking at? Brokers generally are collecting and verifying tax ID numbers of their customers, really segregating who's a US customer, who's a non-US customer, and for the US customers, collecting their TINs and verifying those TINs. The centralized brokers specifically they are in the process of implementing cost basis tracking and calculation software and Form 1099 DA reporting software, in addition to their TIN collection software. And taxpayers are working on complying with that move from the universal to wallet by wallet lot relief. A lot of taxpayers did not act by December 31st, 2024, as Nick knows very well. So that's really just going to continue on through 2025. And we'll see later in another slide, this is also where 2025 is the first year that taxpayers need to self-track and calculate their cost basis on all asset sales. Sorry, it's not the first year they need to do it for all asset sales, but it's the first year for anyone holding an ETF. So 2025 is a year where taxpayers are still self-calculating their cost basis until we get to 2026 and beyond, where we start to see the migration of more and more of these different requirements. So in the interest of time, I'm just kind of focusing on that's what 2025 is, and people can look through the slides later for what comes in the future years. So we can move to the next slide, and we're going to get into a bit of broker issues more specifically before we change lens to the taxpayer. So let's move forward one slide, and we're going to give a quick overview of the DeFi stuff. We're not going to spend a lot of time on this purely because of the lawsuit that was published and the joint resolution that's going through. There are some people out there that think there's a very strong chance the DeFi broker regs actually do get pulled back. I'm in the neutral camp. I can't call it one way or another. But being conscious that if this gets pulled back next week, there's not much to do with it. Let's just give a quick overview of what was in the broker package. So we call it the DeFi broker regs, but I really don't love that name because it's really trading front-end services regs, but that's a really ugly set of words. So we just call it DeFi broker regs for convenient purposes, because the word DeFi and decentralized is actually used nowhere in the regulations. The first question I always asked when I read these was, why was DeFi excluded from the July 2024 package? Not why, we know why, but in what way were they actually technically excluded? And here's how. In July 2024, the reg package addressed brokers who act as an agent, a principal, a paying agent, or as an other digital asset middleman to a transaction. And that other kinds of digital asset middleman include payment processors, that's the PDAP, physical kiosks, and real estate middlemen. And the reason that this distinction matters, so trading front-end services are basically, if you didn't meet one of these other criteria in that bullet, then you weren't in scope of the July 2024 package. And only if you weren't one of those things do you fall into this new package. And this is important because there's a 2-year difference between the timelines. So if you have a trading front-end service, but you are an agent to the transaction or a principal to the transaction, you actually fall into the July 2024 reg package, and you have the earlier timelines and not the 2 years later timelines. So the other thing that's important to mention about that is people have called this the non-custodial broker regs. I also don't love that terminology because you could be non-custodial and still be captured by the July 2024 reg package. Primary example is if you are operating an OTC desk and you don't have custody of customers' assets, you are an agent or a principal to the transaction, and therefore you were in the July 2024 reg package. Okay, so we're talking about trading front-end services. This now forms part of the definition of a digital asset middleman, largely includes browser extensions, apps, and full websites. I'm going to read you some text very briefly of what does it mean to be a trading front-end service? It basically is any app, extension, or website that receives a person's order to sell an asset and processes that order for execution by providing user interfaces. So think UX, UI. And that can include graphic and voice user interfaces. If those interfaces are designed to do 2 things, this is an AND test. enable the user to input their order details, and 2, transmit those order details so that the transaction can be carried out or settled using distributed ledger technology. So it's a specific definition, but we can kind of think of it as these. I have some screenshots on the next slide, but before we move on to that, what does it mean if you are a trading front-end service? You have some requirements that are pretty much the same requirements as the broker reg package from July 2026. You need to collect and verify tax ID numbers. You need to withhold and deposit tax where required, and you need to issue Form 1099 DA reporting, possibly 1099-B reporting, to the IRS and the recipient. But in this case, it's only gross proceeds reporting. And this isn't because DeFi got some special carve out from cost basis. It's because cost basis reporting is only required when you hold custody of the assets. And in DeFi, you don't. So therefore, cost basis reporting is not required. If we move forward one slide, this is what a trading front-end service looks like. If we move forward another slide, here's another example. This is Ledger and Uniswap. These are the kinds of platforms that will fall into scope of this definition, or that do fall into scope of this definition. So if we move forward one more slide, now we're going to just step back into brokers generally, but I know if anyone's listening and they're a centralized broker, this is what they're thinking of, and the DeFi brokers are still hoping that they're out of scope.
Hey, Jessalyn, before
Yeah.
you dive in here, I just want to, we just went through a couple examples of like Ledger and Uniswap. So I think what you're saying, and I'm probably oversimplifying this, but if I'm a customer of Uniswap, and let's assume that these regs are final and they aren't repealed, if I go to trade on Uniswap in the future, they will likely need to request and collect my social security number, name, address, and all those sorts of things before I perform a transaction. Is that right?
That's correct.
And I think to that extent, that's probably why a lot of people don't want to see these regs finalized, is because they want to keep that sort of anonymity or sovereign ownership over assets in place when it comes to these decentralized apps. So I think that's where some of the rub is. But the IRS, I think, correct me if I'm wrong, is basically saying, we don't care. We need to still understand if taxpayers are performing a taxable event, whether it's with a custodian or not a custodian. And so in order to crack down on underreporting of crypto taxable events, we're going to request 1099 DAs from these parties.
Yeah, and we at Ledgible, we wrote a blog out walking through like a summary of the regs, and we made this table that summarized in the commentary that the IRS wrote for the DeFi broker regs. They explain their rationale by comparing DeFi to TradFi. And it's actually very interesting to read, but we summarized it in a table in our blog, where what they're kind of trying to do in that commentary is explain how DeFi is really not that different conceptually from some of their TradFi counterparts. So one of the claims that that DeFi will make is, hey, we're just software. We're not acting as a broker. We're just a software to enable people to go become, trade peer-to-peer. And though the IRS doesn't use Schwab specifically, I'll use it as a name people know. They basically present the case that, well, Schwab is basically just software now too. When Jessalyn goes in to buy shares of Apple, she inputs her order, and it's all software in the background. There is no human intervention in that process. And so that's where they spend a lot of time doing that comparison and trying to say they're actually not that different conceptually. Now, whether anybody agrees or disagrees with that isn't, up for argument here today. That's just, me kind of delivering like, what is the IRS explaining? And so to answer Nick's question, answer is yes to all of that.
Yeah, and I think what is particularly important to keep track of here is these go into effect in a little less than 2 years, right? Well, those DeFi brokers per se, I mean, if you think about it, that really isn't a whole lot of time for them to get this information collected and or to get their system set up to where they can collect this information between now and then. So it's kind of like okay, is this going to be repealed or not? We probably need to know sooner rather than later, because if it pushes into 2026, then it's probably too late for them to start thinking about getting these systems set up. Anywho, I'll let you continue.
Yeah. Oh, great. So some of the biggest compliance issues that brokers generally are going to face with all of this, aside from kind of, some DeFi specific challenges we've already talked about. First one is actually determining their role in the payment or process. I just mentioned on the last slide, if you are a principal or an agent or a paying agent or other type of digital asset middleman, you're in scope of the earlier reg package and the earlier timeframes, meaning 2025 transactions get reported on a 2026 1099. So the thing is, when you're inside a big crypto exchange or a big crypto platform, you might have different roles for different products. So we call this the product analysis, that exchanges or potential brokers need to be doing product analyses to determine what is their role for each specific product. Because again, the timelines are different. Brokers are also facing this challenge of whether to allow customers to provide information to them and how to do it about cost basis of existing assets. This matters so that if Jessalyn puts in an order or a standing order at Coinbase to always sell her assets at HIFO, well, Coinbase can only HIFO if they know, can only properly HIFO if they know the cost basis of all assets pre-2026 and post-2026. So in order for, a Coinbase to be able to allow really proper execution of HIFO, they would need to be able to facilitate acquisition of that other information. Getting knowledge resources in this area, tax information reporting plus blockchain equals big niche. It's really challenging to find people that know this stuff in order to build this out in an organization inside a broker. I mentioned earlier, deciding if, how, and when to apply de minimis reporting or aggregation thresholds is a big challenge for these brokers, because the customers still have to report the transactions separate transaction by transaction, even if the broker doesn't. Smart contracts and automation of tax withholding. This is important for centralized brokers, but it's absolutely critical for DeFi if they're going to need to be able to do tax withholding. And then there's this other big issue, which is this unresolved reconciliation of tax depositing and 1099 withholding and reporting. I'm going to show that on the next slide with an example. So let's just go ahead and dive into the example on the next slide. There's two slides to this. One slide presents what happens to the taxpayer, and the other slide presents what happens to the broker. This is the broker slide. So what facts do we have here? Let's imagine a taxpayer that lives in Los Angeles, US Pacific time. And a broker has employees located in New York, and they do business and tax reporting using UTC, which is a number of hours ahead of New York. So this taxpayer effects a sale with gross proceeds of $1,000. And in my spicy example, there's US backup withholding of $240. And it's at 11 p.m. in Los Angeles, December 31st, 2025. But that's 7 a.m. in UTC, January 1, 2026. So from the broker's perspective, this is not a 2025 1099-DA. This is a 2026 Form 1099-DA reporting $1,000 of proceeds and a $240 tax credit. Now, if we go to the next slide, this is a big problem for the taxpayer, because to them, this was a 2025 transaction. So what they would want to do is report in 2025 that they had a $1,000 sale with a $240 tax credit, but they're not going to get a Form 1099-DA. They have to self-report that transaction. And as I make in the column for notes and issues, you can't take a tax credit when you don't have a 1099 or a W-2 to support it. So if there was no tax credit involved here, it would actually be relatively easy to self-report in 2025. If you've got a small volume of transactions, self-report in 2025, and then reverse it out in 2026. Because in 2026, while the taxpayer doesn't feel this is a taxable event, they will receive a Form 1099-DA reporting to them $1,000 of gross proceeds. So they need to kind of reconcile and back it out of their tax return. But again, with tax withholding involved, this is kind of a what do you do? So we keep trying to highlight this to the IRS as an issue. They seemed to believe that this was not unique to digital assets, but it is, because in TradFi, the New York Stock Exchange stops at 3 or 4 p.m. and it's not open on the weekends, and you just don't have this issue. So this is just going to be an issue. We've mentioned this here as a broker issue, but it is both a broker issue and a taxpayer issue. It's clear why this is a taxpayer issue. This person thought maybe they were doing some loss harvesting on December 31st, but it's also a broker issue because this is a customer service issue. They're going to get phone calls from angry customers. Where's my 1099? Or, hey, you gave me a 1099, but I reported and paid tax on this last year. So this is a broker issue that they will have to deal with from a customer service perspective. Anything you want to add on this, Nick?
No, I think you covered it well. From a practitioner standpoint, it's also going to be frustrating too, right? Because you may have a client that gets a 1099 DA in 2027, but it was a 2026 transaction. So the reconciling between the two is going to be a fun exercise.
Yeah, and it's not unique. It's not a unique issue for 1099s to be in the wrong year. This happens. Partnerships. Partnerships are not exempt recipients, meaning a crypto exchange has to give a 1099 DA or a B or a MISC to partnerships that are their customers. But if a partnership is an accrual basis taxpayer, the 1099 may not match how they account for their income whatsoever. So this is not a unique issue from that perspective, but getting up into 11 p.m. Los Angeles time and dealing with time zone issues and tax withholding credits for individual taxpayers is certainly unexplored territory. So with that, we will move on to the next slide. Where should brokers be in the implementation timeline? So January 2025, last month, a number of brokers would have been issuing 1099 miscellaneous for 2024 staking rewards or other crypto income. Because remember, 1099 DA is for the sales and exchange of digital assets. It does not address income events. Income events are already reportable on other kinds of 1099s, but not every exchange or broker issues them consistently. We already covered the next point. Nick and I wanted to shout from the rooftops. Brokers were not given any more time to implement. Centralized brokers, their timeline did not change with the regs and the notices that we got in December. Timeline was on the earlier slides. So right now, centralized brokers are hiring staff and consultants and forming their steering committees of stakeholders. Please, 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 if you're a broker listening to this, do not leave customer communication as an afterthought. Customer service and customer communication should be at the front of your stakeholder table. This is always the biggest blow up that I see. People just blast out an email or they start doing tax withholding and they never warned their customers about it, and it's a big problem. What else should brokers be in the middle of? Their product analysis. They need to be looking through which products are in and out of scope and why, and what role they have in that product. Are they an agent? Are they a trading front-end service? Are they a principal? They also need to be parsing through which products are specified NFTs versus qualifying stablecoins versus none of the above, because of how the aggregate reporting works and the de minimis thresholds. And lastly, these brokers are working on RFPs for software purchases. Big key message. Don't get to November 2025 and call up a 1099 software and say, hey, can you help me with some 1099 DAs? It will be too late. Code software shutoffs happen in October, November. Many software providers stop taking on new clients at that time. It is too late. You need to be, by June 2025, starting your implementation and testing of your cost basis and or 1099 reporting softwares. Waiting until the last minute is really not demonstrating best faith efforts, and you need to demonstrate best faith efforts to get penalty relief if you are missing deadlines. So with that, we will move on to some taxpayer-specific issues. I will hand the mic back to Nick.
Yeah, the fun stuff, when the rubber meets the road, how are taxpayers going to report some of these things? So let's go to the next slide here. So there are definitely things that will create additional headaches, cause for concern, things like that. And I wanted to highlight those for taxpayers. Jessalyn just did a good job of that for brokers. As I mentioned before, that RevProc 2024-28 gives taxpayers the option to transition from universal to wallet by wallet under a safe harbor method where the IRS will basically look the other way if you meet that safe harbor. And we're going to go through an example here on a couple of slides from now so that you can visualize. I'm a visual person. I like looking at examples to actually see how some of these things are calculated. So we'll go through an example of what that looks like. I'll also answer some FAQs on RevProc 2024-28 as well. Notice 2025-07, we briefly mentioned this before, but taxpayers need, if they want to elect HIFO or LIFO or some other form of specific identification for their 2025 transactions, they need to go ahead and select that now. The final regs said that in order to comply with specific ID, you need to specifically identify the lot that you're releasing before the transaction occurs. Now, there is precedence and there is the opportunity where you have a standing order for a specific ID, such as HIFO or LIFO. So on January 1st of 2025, as a taxpayer, you could say, I want to elect HIFO and just have that as a standing order for the entire year. That's totally fine. You can do that. But that needs to happen, again, before those transactions occur. How do you go about selecting that or doing that? Some things that have been suggested is type it up in an email and email it to yourself, because then you have a timestamp and documentation that you made that election. There's also, if you have access to Adobe, you can type something up, save it as a PDF, and lock it down with a timestamp in Adobe as well. Unclear if you could rely on some of these crypto accounting softwares as that selection. If you've used those in the past, possibly. If you're not changing it from one year to the next, and you simply keep it as HIFO in 2023 to 2024 to 2025, that possibly could be something that you could do. I don't know that that is the most soundproof way of doing it. I would recommend one of those other two methods that I just talked about. But TBD on how the IRS would see that under an IRS exam. When we think about those crypto accounting softwares, it's important also that when you transition from universal to wallet by wallet, that you're locking your past tax years. Some of these softwares, if you generally just go in there and change it from universal to wallet by wallet, it will go back and recalculate all of your prior years as well. And that's a no-no, because now you're reusing cost basis that you've already used. You cannot reuse cost basis that have already been used in prior years. You need to make sure that that's locked down on January 1st of 2025 so that you're not reusing any prior cost basis. Also, some of these crypto accounting softwares don't have the option to transition from universal to wallet by wallet tracking if you were previously on universal. So you also want to make sure that your software supports it. And then finally, inventory reconciliations. This is something that every taxpayer should be doing anyways. Is a lot of times these crypto accounting softwares will show you a balance, let's say at December 31st, 2024. That should tie to what's actually in your wallets and exchanges. And if it doesn't, then that means something is missing or something is not adding up correctly. So go through and make sure that you're reconciling those to what is actually in your wallets and exchanges. That will need to be used to meet that safe harbor in that RevProc 2024-28. And then finally, there is definitely the option or the chance that there are incorrect forms 1099 or blank forms 1099. This will last several years. If we go back to TradFi, this started for TradFi in 2011, and blank cost basis was originally started in TradFi as well, and it took several years for them to get caught up. There's a transition period from where they only issued 1099s with gross proceeds and no cost basis to where they actually got to cost basis as well. So there will be a transition period here. It won't be perfect overnight. And also it's important to call out that blank cost basis is different than zero cost basis, because if zero cost basis gets reported on your 1099 DA, then that becomes very difficult to go against and support something different on your actual tax return. So it's probably better to have blank cost basis and, as a taxpayer, the option to reconcile what it actually is versus an incorrect cost basis that shows zero. All right, we'll go to the next slide. So this is I'll get into an example of Revenue Procedure 2024-2028, but real quick, what the heck is this universal method that we've been talking about? If you're not sure, it's commonly used by crypto tax softwares to determine cost basis. And basically what they would do is they would take all of the client's transactions, whether they occurred across many wallets or just one wallet, and they would mash them into one column. So if you had transactions that occurred over 5 different wallets, it didn't matter for determining on a FIFO basis, a LIFO basis, a HIFO basis, which wallet they were in. They just kind of put it all in one bucket and then determined which lot to release. And this is what the IRS is saying we don't like. We need to transition our taxpayers to wallet by wallet. And frankly, you don't really have an option to transition. This is something that you need to do anyways, even if you don't comply with this safe harbor. So we'll go to the next slide. I'm going to work through an example here. And this is where I'm a visual person, and visually seeing this helps me out a lot. So I'm going to start in the top left, work left to right, and then I'll move down from there. So taxpayer A owns 3 Bitcoin in wallet 1 and 5 Bitcoin in wallet 2. So wallet 1, balance of 3 Bitcoin, wallet 2, balance of 5 Bitcoin. Moving down, and then again on the left side, the cost basis in wallet 1 is $30,000. So in other words, $10,000 per Bitcoin, and $100,000 in wallet 2. So in other words, $20,000 per Bitcoin. Moving down again, the taxpayer sells their 3 Bitcoin that is in wallet 1 on July 15th, 2024. So now their actual balance in wallet 1 is 0. They no longer have any Bitcoin, and they still have 5 Bitcoin in wallet 2. In their records, the cost basis for the 3 Bitcoin that was sold out of wallet 1 is actually removed from wallet 2. And if you remember, wallet 2, the cost basis was $20,000 per Bitcoin. So the 3 Bitcoin that they sold out of wallet 1, they're going to reduce their cost basis by $60,000. You can start to see how this doesn't really match up very well. So the balance, moving down even more, the balance of cost basis, there's still $30,000 of cost basis in wallet 1, yet there's no Bitcoin in that wallet. And there's $40,000 of cost basis in wallet 2, yet there's still 5 Bitcoin in that wallet. So there's a mismatch here where there's a balance of 0 Bitcoin in wallet 1, but somehow $30,000 of cost basis left over in that wallet, and a balance of 5 Bitcoin in wallet 2, and only $40,000 of cost basis. So that's where using a universal method could create some imbalances. And this is what the IRS wants taxpayers to transition away from. So if we'll go to the next slide, how do you meet that safe harbor? How do you, comply with that so that the IRS does look the other way if you did comply with this? Well, there's 2 different ways. Unfortunately, the global allocation, if you haven't already complied with that, it's probably too late, because taxpayers needed to do this before the later of the first sale or disposition or transfer on or after January 1st of 2025, or the due date of the taxpayer's federal income tax return, for which taxable year includes January 1st of 2025. So I say it's probably passed. There's still a chance that global allocation hasn't passed if you're a taxpayer and you haven't performed any transactions in 2025 yet. So you can still comply and use a global allocation if you want. This is basically all you have to do, is describe the global allocation in the taxpayer's books and records. And now that I'm reading this, I'm correcting myself. You had to describe the method in the taxpayer's books and records before 1/1 of 2025. So maybe this is passed. And looking at the specific allocation, this one is still available, again, if you haven't performed a transaction in 1/1/2025 or not. This has to be done before the first sale or disposition of a transfer by the taxpayer on 1/1 or 2025 or after. So this is the one where if you haven't performed a transaction in 2025 yet, you can still use the specific allocation. And this is where you basically, you go through, you take your unused cost basis and you allocate it specifically to each wallet. The IRS is actually, in my opinion, playing pretty nice here and giving taxpayers the opportunity to maybe even go through and allocate low cost basis to a wallet that they don't use very often, and higher cost basis to a wallet where they do maybe use pretty often. And that could be a tax planning opportunity where it could reduce their gain or loss going forward. So some FAQs real quick about this. You don't have to submit anything to the IRS if you're going to comply with this. This is all done in your books and records. So it's almost like a why not? Why wouldn't you go through this process to document this in your books and records, and it protects you for those years prior to 2025 if you did use the universal method. And I think just in the essence of time, I'm probably going to go to the next slide. But if you have additional questions on that, happy to jump through those later.
Amazing. I was able to follow that brilliantly. So I have questions about it, but we'll take them offline. So let's dive into the ETF issue. Before I get into this topic, this is not a new issue. This issue I'm about to describe also exists for other kind of commodity ETFs like gold ETFs and silver ETFs. It's just that the average retail investor, sorry, my light just went out, so you're gonna have to see me in the dark a little bit. The average retail investor was maybe not buying gold and silver ETFs. So what happened in 2024 for the first time was we had the launch of the spot Bitcoin ETF and later the spot ETH ETFs. And there's about 19 of them out there. But IBIT, BlackRock's spot Bitcoin ETF was the fastest ETF to $40 billion in assets. It reached that level in like 210 days, 5 times faster than any other ETF. There's a lot of money in these ETFs. And it's already in the top 1% of all ETFs and one of the biggest launches in 10 years. So a lot of funds flowed into these ETFs. Tax steps in and ruins the party, as it typically does. Almost all of these ETFs are structured as grantor trusts for tax purposes. What does that mean? It means that the taxpayer is treated as owning the underlying crypto assets indirectly. Their allocable share of sales inside of the trust must be calculated via a tax information report. We've got a screenshot on the next screen that is found on the issuer's website. I'm going to pause right here. Broker and issuer are not the same thing. Issuer is Grayscale, Bitwise, BlackRock. Retail investors cannot go to any of these places and buy these ETFs. You buy them at a broker. There's like maybe 5 to 10 brokers that offer these ETFs. You can buy them at Robinhood, I think Fidelity. Those are the kinds of places that you can buy these. So what I just told you is that you have to calculate the taxpayer's allocable share of fund level sales via a report found on the issuer's website. So if you are buying these ETFs from a broker, like a Robinhood or Fidelity, you're not getting a tax information report from them. You have to know what I've just told you and go seek out the report yourself. Now, this is difficult to explain, but we have an example on the next slide. The gross proceeds from sales of the ETF interest itself are reported by the broker on Form 1099-B. Again, I'll show this on the next slide. Likely has no cost basis because trusts are not specified securities and therefore not covered securities. And if the broker does report cost basis, it's likely incorrect, and the taxpayer needs to recalculate their cost basis using tax information reports through time from the issuer. Tax advisors, this is an issue even if your client does not sell any of their interest in these ETFs during 2024, which means you need to ask on your yearly questionnaire, did you buy any of these ETFs? This isn't a question of selling, it's a question of buying. Did you hold them? So let's move on to the next slide and walk through an example. It's much easier. So most taxpayers rely on their broker like Robinhood or Schwab or Fidelity to provide them with their complete tax reports. They think I get my 1099s from my broker each year. But when these grantor trusts are involved, taxpayers will only receive from their broker a portion of the information that they need in order to be compliant. So our simple example, year 1, 2024, Jessalyn buys and holds 100 shares of spot Bitcoin ETF through my broker. Year 2, I still hold those 100 shares of my ETF. Year 3, I sell my 100 shares of the ETF through my broker. In year 3, Jessalyn will receive a 1099-B from her broker, Robinhood or Schwab, reporting her sale of the 100 shares of the ETF. No cost basis. And if there is basis, it's probably wrong. Years 1, 2, and 3, Jessalyn also needs to pick up and report the gains and losses that are passed through to her from inside of the trust. With grantor trusts, unless the broker has included it on a Form 1099-B or DA somewhere, most of them do not, it's up to the taxpayer to know this, or their advisor, and go download the additional tax report from the issuer or trustee's website. Grayscale for GBTC, VanEck for HODL. And in this case, if Jessalyn had not been aware of this, which most taxpayers are not, she may have underreported her allocable share of fund level gains losses on her taxes for all 3 years. If it was a loss, then she lost out on some losses she could have offset against some gains. And if it was gains, she may have a tax bill that she doesn't realize that she has. So if we go to the next slide, this is 2 pages out of 17. These tax information reports, this is an example from Grayscale, show you all of the moments that the fund had to sell Bitcoin in order to pay fund expenses. Why are they selling Bitcoin? Because accountants don't typically take Bitcoin as payment. They need to be paid in fiat. So the accountants and the auditors all need to be paid in fiat, so the fund has to sell crypto in order to pay them. And Jessalyn needs to pick up her allocable share of gains or losses on that sale. Now, Nick and I had this really interesting conversation of like, what kind of numbers does this quantifiably add up to? Is this really actually a big deal? And I don't know if it's visible on the screen here, but in this case, this investor owned 20,000 shares of this ETF, and their gain, their taxable gain, is about $5,000. So that gives you a good litmus test of like, how big of a deal is this to like small time investors? It's really going to be bigger positions where this matters, because we can see in this case, 20,000 shares is a pretty large position. I know we're running short on time. We have 3 minutes left. I'd like Nick to run through the next slide, which will be our last slide. And then we did have one last section about missing guidance, but it's actually really big bullet lists. So if people want to read through those last slides on their own, you can reach out to Nick or I with questions about what's in that list. Our contact details will be at the end, but I will hand to Nick to walk through this slide.
Yeah, and I just also want to say thank you all for listening to us and dive into some of these niche topics. So one thing that I want you all to take away from today, and I think Jessalyn has done a good job of this too, is that this is not getting any easier. Just because we're getting 1099 DAs in the future doesn't mean that reporting these for taxes is going to be any easier going forward. So what are some of those issues? What are the concerns? The move from universal to wallet by wallet lot relief. Even if a taxpayer didn't meet that safe harbor deadline, they still need to transition. They may not get that penalty relief, but they're going to be required to transition anyways. So that's one thing that we're going to have to be aware of as taxpayers or practitioners that are in this space. 1099 DAs, a lot of them probably won't have cost basis. First of all, it's not required in 2025 over 2024 or in 2026 over 2025. In addition to that, cost basis in 2026 and going forward is only required if the crypto is bought, held, and sold within the 4 walls of the custodial broker. So for example, if I buy Bitcoin in Coinbase and then I send it to a non-custodial wallet and then I send it back to Coinbase at a later time to sell, they don't have to report cost basis on that. So it has to stay within their four walls at all time. ETFs are trust, as Jessalyn mentioned, so they're technically not a covered security. So technically, they may not even need to be reported on a 1099. And then finally, DeFi is non-custodial, and those assets will be not covered securities, so they won't need to report cost basis. There's also the scenario that we didn't really touch on a whole lot, but some of these brokers, they have a safe harbor where if they make a good faith effort, they don't have to issue these 1099 DAs until up to a year later. So you could have a taxpayer that files their tax return and they get a 1099 DA for that tax return after their tax return has been filed. Could cause a reason to amend the tax return. There's also de minimis thresholds. This is where the IRS has said for stablecoins and NFTs that you don't necessarily have to report them all on a 1099 DA. And there's also certain transactions that the IRS has withheld from being reported on a 1099 DA, such as wrap tokens, staking, and some of these other niche types of transactions. And then finally, there could be duplicate reporting with tokenized real estate on K1s and 1099 DAs. I know we went a little bit over there. Appreciate you all joining us. And there, as Jessalyn mentioned, there are a couple slides that we didn't get to, but happy to share the slides after this presentation.
And if you want to jump to the last slide, it has our emails and contact details.
And Jessalyn and I are also very active on LinkedIn. So I have a hunch that if you reach out to one of us on LinkedIn, we can get back to you through there as well.
It's like the best way to contact me.
Nick, Jessalyn, thank you both so much for your thought leadership on this important issue. I think we've got a couple of Q&As left for those who have stuck around. I appreciate it. Thomas Garrity, having to go to an ETF issuer is akin to having to go to an issuer of a PFIC stock for QEF information. Broker would not provide that either.
I'll basically just agree. So there wasn't a question there. I think Thomas is just calling out like, hey, there's other instances in the tax world where we don't get 1099s, and this ETF thing is kind of like the PFIX. Tax advisors need to do some extra work. My key message for taxpayers is if you bought those ETFs, you should hire a tax advisor. Like, I would not go at it alone. You don't have the capability to calculate that information out of those reports. At least I don't, and I'm a tax expert.
Right,
and Wendy said loved the presentation. There was another question from Charles that I answered privately.
Excellent. We will leave it there. Again, Jessalyn, Nick, thank you so much for your thought leadership on this issue. We're going to stop the share right now. If you have additional questions for Jessalyn or for Nick, drop us a note, info@wsba.co, or reach out to Nick or Jessalyn directly on LinkedIn. They are the thought leaders in this space. We will end it there. Thank you both again. We will have the recording available on the WSBA YouTube page as well. Until next time, Nick, Jessalyn, thank you so much for everything. Super important topic. Looking forward to catching up soon.
Thanks.
Bye-bye, everyone. Take care.